All right, anyway. Let's do the fun part. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed, contract, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. NEGTStockWorld.com, TSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities as licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. TSW provides education and trading services that are meant to teach you the risk and potential rewards of trading options, and we are not a service that tells worth to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance is not equal to future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed in our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and Greg, this should be and. We will not distribute or sell your information to anyone. We got to fix that. That's silly to have a typo. Anywho, how's it going, kids? Yes, recording. Thank you, Jim. Phil, would you explain how to draw lines in the future? So these Fibonacci. No, Fibonacci. What a joke. All right, we'll do that. Can you discuss how and when to adjust the Tesla trade as it rises before it collapses? Well, okay. First of all, the Tesla trade is not in the portfolio. It's a risky trade, for one thing. Be very clear about that. And we certainly do expect it to go against us, and we're going to roll it to a, we're basically making a small position now, and we'll take a more serious position. And when we do if we do have to roll it, that's when we want to add to the portfolio officially. But right now, it's just something you have to assume is going to go against you because these people are crazy, the Tesla fans. How long do we hold a futures contract on the average? Less than a day. I mean, I prefer to hold them for like 15 minutes if possible. I mean, if you average it, there are some I'll take for a long-term play, but I mean, generally, so that would bring the average up. But generally, I mean, I much prefer in and out, gone. I like to see something happening and be done with it. So where are we? We're topping out. Don't forget the Fed is in an hour, and everybody, of course, is very excited. We expected this. Everybody's all excited that the Fed's going to... First of all, they're not going to do anything because it's just the freaking minutes of the last meeting. It's so stupid. And since the last meeting, what they really are expecting is to say which side of these people really are. Are they bullish? Are they bearish? Are more Fed people leaning one way or the other way? It's all about minutia right now. Clearly, they're not raising rates. Clearly, they're not moving quickly to raise rates. Clearly, if we have 2 rate rises for the rest of the year, that's going to be about as much as is going to happen. So what? How does that affect whether or not IBM makes money this quarter? It really doesn't. I mean, it's a very odd sort of thing that we've gotten so focused on the Fed as if everything they do is more important than what the companies we invest in actually do. Anyway. Ooh, I like Amazon. I know Amazon is 600 again. I like Amazon as a short up at 600. But again, it's a tough environment for shorting. I mean, look at Tesla, 266. I mean, it's freaking killing us on this trade that we just started. But again, we talked about that this morning in chat because what happened is our friend Musk, this guy is an unbelievable manipulator of stock. I can't believe they don't arrest him. I don't understand. What's the point of having an SEC if they don't even care? I mean, this is, it's a flagrant public thing. This isn't like some little guy making a comment somewhere. They bust Martha Stewart for whatever reason, and yet this guy gets to do. I gotta show you. I gotta show you what he did because it's just unbelievable. There it is. Okay. So here's Elon Musk. Okay. Keep in mind he's the CEO of this company, and here's his Twitter conversation. Oh, I'm sorry. It's the audio from this thing. So here's the thing. What actually happened, this guy Brian goes, what would you say to someone who is shorting your stock? So he goes, that probably unwise, okay? You could say that's vague, but you can't be vague or anything when you're the CEO of a company. You can't do that in Twitter. It's like a disclosure. Now, Kramer takes that little thing and runs with it for how long was the segment? 2.5 minutes. Kramer talks about how Elon Musk said, don't short his stock. Because that's the point. So Musk is pushing the level of the law by saying probably unwise. It's not a definitive statement, but who knows who Brian M is? It could be his friend Brian, who he told him to ask that question. But Musk goes, oh, probably unwise. That gets picked up by the media all over the place where they say, Elon Musk says, don't short this stock. And you know why? You know what's going on right now? The reason that you have these idiotic valuations coming out for Tesla and so on and so forth is because Tesla is almost out of money. And they have to go and do another round of financing. Now, they'll do a convertible debenture, or they'll do something. Who knows what they're going to do? But they need to raise another probably $2 billion. And last time he did it, he had an excuse, well, building this gigafactory. So we need $2 billion for that. That sounded like a good reason to give them $2 billion. And maybe it is, who knows. But now they need $2 billion because their operation is bleeding cash. All right, and so let's take a look at Tesla and see if we can, I don't know how up to date Yahoo is, but TSLA. And I want to make it clear, I don't hate Tesla, I just hate stocks that are overvalued. It's not like I don't like the car or the company conceptually. But this is ridiculous. Income statement, here we go. Oh no, it's not really, it's a balance sheet. So it says they have $1.2 billion in cash, is what it says they have on the books. Or cash, you got to be careful with them because cash equivalents, who knows what they're counting. $1.2 billion in inventory, that makes no sense. They've got 25% of their cars are in inventory when they only ship them on order. How is that even possible? So the whole balance sheet's a little bit questionable. Property, plant, and equipment. Notice they never depreciate. They always go up and up and up in their property, plant, and equipment. That's interesting too. But anyway, so then you go to cash flow. So remember, they got $1.2 billion in cash supposedly, and here's what they're dropping: $229, $359, $395 each quarter. They're losing about $100 million a month. So $1 billion is not going to last them very long, and that's again, these are all non-GAAP numbers. These are the numbers that Tesla reports, which are non-GAAP. When you look at the GAAP numbers, we looked at those yesterday in the post. Let's see if I can pull that up. And GAAP is generally accepted accounting principles. So this non-GAAP just means bullshit. When you hear non-GAAP accounting, that just means bullshit accounting. It means whatever they made up. It's not non-GAAP means not according to generally accepted accounting principles. That's what GAAP is, generally accepted accounting principles. In other words, this is what's real. GAAP is real. Non-GAAP is just bullshit. Where was it? Oh, here you go. So when you look at their GAAP EPS, it's way down. It's negative. This is the GAAP EPS. It's minus $2.50 a share. Non-GAAP, they're reporting minus $1 a share, not even $1 a share. Now, in cash flow, as you see, they're down, burning closer to $450 million here in the quarter. All right, after burning $600 million in September. So even if they do bring it down, they only have maybe 2 more quarters after this quarter. Well, this quarter's gone. So assuming that they burned $300 million this quarter that just went by, they only have two more quarters of cash to burn, and it means that they can't be investing in anything. You can't buy anything new if you can't buy another $1 billion worth of stuff if you're going to run out of money in 2 quarters. So if they are going to expand their plant and add a product line and ship more cars or whatever, they're going to have to raise some money. There's no real way around it. They either have to raise the money or start making a huge profit on the same exact cars in the same exact configuration that they were shipping last year at the same exact amounts at the same exact prices. So either something magical happens or this will continue, because why wouldn't it continue? How can it not continue if this is the way they're building their cars? This is their functioning company. They gave glowing reports here and said how great everything was. Meanwhile, $1 billion this is over $1 billion burned in 2 quarters. So really, I mean, look, the bottom line is that all I'm trying to tell people is don't buy Tesla. I don't care if you short it. Okay, really, honestly, it's a terrible market to short anything. I mean, the same thing goes with Amazon. Amazon is $600. That's stupid too. But it's a scary thing to short. All right? But at some point, if you're long on Tesla, you can get really stuck in this stock. Because, well, here, I mean, why do I even have to explain this? It's interesting because it really is weird. Because it isn't like it isn't like we have to go back to ancient history. In December, they were at 243, and in February, maybe February, they were at 140, 141. That's $100 out of 240. That's what is that? 40-something% drop, 40-something% drop in a month. It was early February, so in 1 month, boom, and look how fast it went down. Boom, no. Will it recover? Oh, I think it's going to recover. Oh, no. That's not what the market did. The market went down, but not that much. So any little thing can set them off. And here it goes from 286 to 195, $100 drop. Here's 291 to 181, $100 drop. Here's to 170, like $100 drop. This is what they do. Ramp up on bullshit excitement, come back down when something real happens, More tweets, more promises, and then reality hits. Now more tweets, more promises, and then reality will hit them. Okay, you just have to be able to ride out the bullshit to the top. That's the problem. You have to be very careful about shorting because you can't let yourself get stopped out. They could go all the way to 300 this time before they turn back down. But if you're shorting, that should make you excited. The same way we buy more stock at the bottom, you short more at the top. But the problem with shorting, though, is it's different than buying, because buying, you can at least hold the damn thing. But shorting, God forbid they go to 400, you're just screwed. You lose money. There's no question about it. So it's not like I'm saying short Tesla, it's a great thing. No, I like shorting because I'm willing to take the chance. But realistically, just don't buy it. It's stupid. That's all I'm saying. All right, let's get back to here. All right, futures we'll get to shortly. Oh, that's how we got on that topic. So when you explain the SL trade did well today, silver SI, not SL, trade was a home run from 15 to 60. So when you explain how the SL trade did well, I don't understand. It was not in 1 day. Yeah, it was. It was in 1 day, and in fact, it's happening right now again. It's going up again like crazy, silver. Where is it? There it is. See, did it again. So this morning, in fact, the same place, 1520. So this morning we took a long again, and again it popped to the same place. It did it yesterday. Here's 1505, where we entered yesterday. Here's 1520. Here it comes back down to 1505. It actually went lower, all the way to 1490 almost. And now it's back to 1520, but quickly rejected and back down. All right, but that's us. That's people. That's our guys selling at the targets, and that's our guys buying at the targets. And now we're back at 1505 and ahead of the Fed. I don't see any reason why you wouldn't want to be long here. I mean, stop at 15, of course, if it can't hold 15. But you can go long again on silver because what's the Fed going to do? They're not. The minutes aren't going to say, "Oh, we're really going to raise rates." Don't tell anyone until the minutes come out, but rates are going up. That's not going to happen. So all the minutes are going to do is sort of reiterate the fact that they're in no hurry to raise rates, and they're still looking at the data and still worried about this and that. Therefore, the dollar stays fairly weak, and metals will have a little bit of a relief rally. So, you can expect to see 1520 again. Here's the dollar just languishing down here at 94, and this is what the dollar is doing. This is that writing to the Fed, and it's not going to go significantly down, but this is about the right price for the dollar. Oil, as we said before, topped out because Brent topped out. You see how Brent? That's not Brent. Where's Brent? No Brent. Okay, hang on. Let's change natural gas for a minute. There. See, Brent topped out at 40, which is what we figured would happen. Therefore, whatever the relationship is, natural gas at like 37.69 was the exact 5% line. See, it's 5.02%, 37.69. So 37.69 is where you expect to have a fairly natural stop because that's a 5% rule. That's why we have a 5% rule. When something goes up 5%, it stops going up. See, Brent, 5% rule, 5.02, 5.02. Okay? Humans don't trade the market. Computers trade the market. We just play along. All right? Computers will move the market 5%. When there's a fundamentally bullish change to a widely traded commodity, to something that's widely traded commodity or index that's extremely liquid, it's going to move in a 5% increment of some sort. It could be 5%, 2.5%, 1.25%, 0.67%. They're all valid. But you expect to see a 5% move. A 5% move is where you get into a major completion. It's very, very hard to break that without some kind of pullback. All right, and gasoline was easy this morning. We called gasoline at 37.50, and we got a nice ride up to 140. Now it's rejected, but it's not really. You know, I mean, again, it's a strong pullback, a weak pullback. So far, it's a weak pullback. All right, a stronger pullback would be coming back down to around 139. I don't know if we'll see that or not, but 139.5, that's just a weak pullback. There's nothing, I mean, it's natural that it should pull back. It's not normal for these things to go past 5% and keep going. What's normal is 5% and pull back. I mean, this is pretty strong because we're just consolidating the 5% line. So the only reason they didn't go higher is because they hit the 5% line. But if you were of a mindset to short, that would be where you want to jump in short. I don't see any reason to short oil here. We just took long from USO and UCO and whatever. So let's see if there's anything to trade. What's good in tradable? See, into the Fed, it's kind of hard, though. We could have too much of a move one way or the other, so I wouldn't really want to get into this now. I think after the Fed, we'll probably see if we can find something to trade. Nah, none of these things are really exciting to me, other than shorting Amazon. Other than shorting Amazon, I'm not terribly excited. Natural gas isn't bad. Cheap, anyway. So natural gas came down nicely back to the 190 line, but as I was saying this morning to the members, I think maybe 185 is about the natural line. Oh, that's a good time to talk about this futures chart, so let's take a look at that. Futures. So somebody said something about how do we find the level in the futures. Well, we go to the chart, and first of all, there's our 5% rule, but how does the 5% rule work? Well, it works out, first of all, you eyeball it. Where's the bottom of this range? Well, obviously 185 is the bottom of this range, right? There's no clear support at 190, although it's okay here. If I saw 190 firming up, I could justify it here, but clearly there's good support at 185. So I'm a lot more excited entering a bet at 185 than 190 on the hourly chart in the short term. Day chart, yeah, that's barely. There's your 185 line, right? Doesn't look so exciting now. That's a support. If we're going to bullishly break out over 2, this is a good consolidation pattern. This is exactly what you want to see preparing for a breakout. But what you need to see is 185 has to hold and $2 has to break higher on this next run. Otherwise, we're just consolidating for probably another failure. You know, just like here, in fact, you know, here's a rundown. We came back to 250, same way as this did, right? Come back to 250, little poke above, coming back down, going to try to come back over, but oh, fail. And that fail is the really bad one, and then boom, down you go. Okay, now we'll go to the weekly chart. Now I say, well, you know, for the last year, I'd have to call this $2 line kind of significant. So if we get back over it, that's probably a nice bullish support line, $2. After that, obviously you got $2.50, and then you got $3. You can see these things. But in a realistic time frame of days, where would I be drawing my line? Well, I could clearly draw my line here, which is 185. See it cross down to here. And then from 185, where are we? 350. Now, What I want to do is find out, first of all, here's the math of the thing. So if we say 350 minus 185 is 165 divided by 350, 47%. So that's about so basically it's about a 50% drop. And I'm only eyeballing the 350. So let's say though that that's correct. So if we say 350 is generally the top, and we can go weekly and confirm that. And see, here it is, but obviously there's no confirmation really of 350 except for like this a few years ago. But it's only a recent top, but it's a good one. Anything less a year is a good. Anything goes over a year is a good consolidation point. So let's say 350 is the real line. Now we know we're down 40% from 350 already, 47. But now let's see what we expected. What if we were down 40% from 350? So the 350 times 0.6 is 210. So that means now 210 would be the 40% minus line. What's the 50% minus line? Well, obviously 175. Now, we know 175 held. That was actually the low of the whole thing when it spiked down was 175. 160, I think we hit briefly. This is not the same contract that hit 160, so you don't really see it here. The hard thing about these charts is the front month contract is constantly adjusted. So this contract, the April 6th contract, see here? Well, not the April, I'm sorry, today's April 6th. The contract we're looking at now, which is the May contract actually, it never hit 160. It was the March contract or April contract that hit 160. I know that's very confusing, but so this chart is a chart for the current contract, which never made it to 160. But, so, there's no but. It's actually kind of complicated to think about. I don't think about it much anymore, but it is confusing. So just keep in mind, though, this is the current reality for the current contract. So you always have to adjust based on the contract a little bit. You have to just take those bonds for what they're worth. Where was it? Oh, yeah. So the bottom would be 175. And we have that confirmed here. Because here's 190. This has got to be about 175. And, oh, I'm sorry. We can zoom in on that. Go to the hours. There's 185. Oh, that's as good as it gets. Okay. We don't, March 28th. Hang on. Oh, no, that's only bringing us back to here. So down here is clearly, oh, yeah. There. Obviously, here's a good view. $2.150, so 175 is right there. That is 175. So here's a little bit of evidence. So 175 clearly held. 350 is our top. Now we do the 5% rule. So now we know that we had a drop of 175. 175 times 0.2 is 35 cents. So that is what you call the bounce line. Okay, a 20% retracement of whichever way it went is going to be your bounce, or if it was bullish, it would be your retracement. So it's going to be now 175 plus 35. 175 is 210. So if you want to see a weak bounce off of 175, you should hit 210. And you see what this is? It's a weak bounce. And we got rejected at the weak bounce line. So now we can zoom back in. So far, all this entire move from here to here was a weak bounce off the broader drop from 375. And by the way, what happens? What's above 210? 245. You see this consolidation here? That's a strong bounce. 210 plus 35 is 245. That's your strong bounce. And so you have a strong bounce, a little nose up. This is why we throw out spikes. In the 5% rule, you always ignore spikes, and you look for the consolidations, because that's what's real. This could be a news, it could be a one-day thing, it could be an event, it could be the dollar drop. Who knows? But it's not, when you see trading day in, day out at a certain level, consolidation, that's real. So what's real here? That's real. So here's a strong bounce, which is, nice, you expect that. But then we fail the strong bounce line, come down to test the weak bounce at 210. Now we fail that, go all the way down to the 50% drop at 175, And now we're weak bouncing off 175, fail, back, fail, and now, actually, you know what? I mean, from a purely technical standpoint, you're probably going to see 175 again. So, no, not a good time to be long on natural gas. We got out at 2 or 205 or whatever it was. We got out here, and we haven't gotten back in since. In fact, see that big volume spike? That's us getting out. That's when we gave up on that. So it doesn't change my mind about UNG, because UNG is a play for like a year from now, 2 years from now. So it's got nothing to do with the long-term premise, but in the short term, this thing is not ready to come back. Plus, this time of year, historically, well, it's a spazzy thing, but see the crazy spike, then down, okay, and then here down into the summer, down. Well, it kept going down, but here down into the summer. This one was an outlier. This one went up and then down. This one went down and kept going down. This one, they all go. There's very little positive action into the middle of the year in natural gas. That's the bottom line, right? So why will this time be different? No particular reason. All right, the LNG exports have already started. It's already been in the news. That was our upside catalyst that we wanted into April. April is now here. We took the money off the table when we hit our goal of $2. And now we just have to wait. And so if it goes back on sale, then I'm going to like it long. But right now, it's really not particularly exciting long. And again, I don't want to hold the futures for that long. All right, so in and out repeatedly to make mention. We just keep we play the line. You know, it's like when you're playing anything, you pick a line, and if you get a little run and it runs out of momentum, you get out. Then if it comes back to your line, you say, "Oh, let's play that again." So yeah, that's in and out, but that is how you're supposed to play the futures. You're not supposed to ride them out. You get your play, you pick up the momentum. When the momentum slows down, you start getting ready to exit, and then you get out. But you could sell the January 18 $30 Tesla put for $1. Dumb trade of the day. Sell the $30 put. That's crazy, isn't it? Wow, $30. I still wouldn't do it. I don't know. It's not worth $1 on the off chance that they go bankrupt between now and then. It's almost certainly not going to happen. But I guess in certain margin accounts, it's not a bad move. And can you explain the lines? Okay, I hope I explained the lines. Your explanation for the BHI reaction today. What BHI reaction today is it? I love everything else. I don't know. I don't know what BHI reaction. Open a new tab. BHI. Are they freaking out? Is it down? Oh. The only explanation I have is it's a freaking bargain down here. Who's asking that question? Sorry. Lunar. We just talked about this, BHI here. I'm going to go back to what I said, otherwise I'll start like saying something that I mean. Here you go, BHI. It's possible that even the filing of a suit. This is me being an M&A consultant, okay? So it's many years of seeing this kind of stuff. It's possible that even filing the suit is just a negotiating tactic by the Department of Justice. What's been going on is that Halliburton has sold a lot of assets already. They sold maybe when they first got together with the Department of Justice, they were like, okay, you guys got to shed about $7.5 billion worth of assets for us to feel good about this deal. They don't want one guy to control too much. So they said to Halliburton, if you sell off $7.5 billion worth of these kind of assets to other competitors, then we'll feel the market is balanced enough that you can make this gigantic combination, merger. So that was the agreement. Now what happened is the market crashed. Right after this deal was announced, the market crashed. Halliburton is selling a bunch of assets, but the problem is they sell $5 billion worth of assets that were things that people really wanted. That wasn't so hard. But now for the last 6 months or so, they've been trying to sell $2.5 billion worth of assets they can't get a good buy for. So they're kind of like, well, we don't want to sell this stuff at a fire sale price, which is where it is right now. And they're saying to the Department of Justice, very justifiably, by the way, they're saying to the Department of Justice, hey, these assets are worth half of what they were. You told us you wanted us to bring our asset base down to X. Well, based on these prices that we're getting now, our asset base of the combined company is now lower than what you asked us to get to. Now, that's logical, but the Department of Justice doesn't have to be logical. They're not stock traders. The Department of Justice is like, no, I don't give a crap what it's worth today. That's a transient thing. We told you you have to sell these assets, and we don't care whether you get $7.5 billion for them or not. We only care that you sell them. And that's where they're sort of stuck. Since they're stuck, the Department of Justice is saying, okay, you know what, you're either going to sell these assets or we're blocking the sale. So they're threatening. I don't think they've actually done it yet. They were only threatening to go to the to file a suit against them. And by the way, I don't even know that they threaten. There's only a rumor. The whole thing is just based on rumors. So it's hard to say if you should believe any of that. And I've already told my members, it's like they're probably just trying to chase people out of Baker Hughes all along, because Baker Hughes loans right now are going to make a fortune. And the lower they can get it, the more all these fund managers can jump in and buy more Baker Hughes. That's what I said the other day. I said, do more Baker Hughes. This is crazy. How can you possibly look at this stock and not want it for $40? They're going to, if the deal doesn't go through, they get $3.5 billion. Okay, that's 20% of their entire market cap in cash. Only Apple has more percentage of their market cap in cash than Baker Hughes would. Okay, it turns them into a completely different company. They have, and not only that though, but the same way Halliburton is not able to sell $2.5 billion worth of stuff because they can only get maybe $1.5 billion for it or even less. Baker Hughes gets to be the buyer of those kind of assets. So they then become a huge beneficiary of this thing, and they'll get to make themselves much bigger and buy a lot of cheap assets and move forward. So that's why it's going up today, because I'm not the only person who sees that, or maybe because I said it and other people see it. maybe I'm not the only person who sees it because of that. But that's how it works. You have to look at the whole picture of what's going on. All right, Freeport. Where did I open that thing? Oh. FC. And that, by the way, is why you don't react to rumors and things that are unsubstantiated, and even things that are substantiated when they are facts. You still have to think about what the real impact of something is. So what would I do with FCX? I like FCX. I like them long term. I think one day, I've been saying this for years, but one day a government is going to build something, and they will employ people. And it will be good. And then other governments will build things and employ people, and they will see that it is good. And then there will be a multitude of building and hiring and whatever. And commodities will come back, and infrastructure will come back, and all kinds of good things will happen. I don't know when that's going to happen. So I don't understand. I really, for the life of me, other than saying there's a global conspiracy to just keep the middle class poor, to not help people, because we went through this. We had a Great Depression, and it was very obvious that the government's going and spending money and building things was the absolute best way to put people back to work and improve a country. And by laying a foundation of better roads and bridges and hospitals and schools and so on, by building all this crap, whether you needed it or not, you lay the foundation for 20 years of growth after that. You can't say nobody knows this, yet that's now called Keynesianism. And Keynesianism is now as vilified as communism is. But it's the only thing that's ever worked. All this other stuff is just bullshit, and it's destroying the country. And by the way, and the other thing is, this very interesting thing is that they, and they being the people who control the media and so on and so forth, what they've done is they call QE Keynesianism, but it's not, because Keynes never said, take a lot of money and give it to the banks. He never, ever said that. Keynes said the government should spend money to employ people and build things. QE does not build anything, and it doesn't spend any money. All it does is put money into banks. It trades bad assets that they want to get rid of, including bad bonds. So either bad bonds that the government wants to sell, because what idiot wants to buy a bond for 2%? Only the Fed. So they're either buying bad bonds, and also they buy the bonds that the banks are already holding, that the banks want to get rid of. So they're buying those, and then they're buying other assets, like bad real estate assets and so on and so forth from the bank. The Fed's buying those too, and that doesn't help anybody. That doesn't employ anybody. You're just creating money and exchanging it for bad assets. That's a terrible idea. And it's got nothing to do with Keynesianism. Yet they blame Keynesianism for, like, the debt. They say, oh, that's how you go into debt. No. Keynes said you intelligently spend your money to create jobs and put people to work. And then the people to work have money. They spend the money. And you know what? They make intelligent decisions for the most part. People who have money, when they're poor, they make the best decisions they can with the money they have. Governments don't necessarily, and banks sure don't. Banks do stupid things, like buy Tesla. Let's see. So FTX, I like them long term. Dow is correct. Oh, by the way, on FTX, let's take a look at the trade on them, because they're on a good position to buy. FCX. This goes back to that same kind of thing I was talking about this morning in the Post. It's like you don't have to take a big risk to get bullish on a stock like FCX. You can sell. Now, I want to point out, oh, by the way, FCX is something I featured. FCX was a featured trade when I did my webinar, not a webinar, whatever it was I did at the Money Show. When I gave my thing at the Money Show, my presentation, FCX was my featured stock at the time. And that was where, FCX? That was around here, right? I think it was in February. Anyway, it was down here at the time. So now it's like doubled since then. But as a now trade for FCX, the reason I like them in the first place, they have fantastic options. And even now, you can sell the $5 puts. So they're at $9.50. You can sell the $5 puts for $1.30. That nets you into the trade. These are $5 puts. That nets you into the trade for $3.70. That's almost like a third of what they're trading at now. So you get, 60% off by selling the $5 puts. Now, you can just do that. I mean, your worst case scenario is owning them for 60% off. Your best case scenario, let's see if we sell 10, what happens? So 130. All right, so here you go. You collect $1,300 for selling 10. And what's your commitment? Your commitment is your worst case is you're going to buy for $370. So that's $3,700 for 1,000 shares. Is your worst case scenario? Is that you own $3,700 worth of FCX? But to do, in exchange for that promise, you're going to get handed $1,300 right now, which is what? More than a third of that. So you're basically getting 33% return if you have an IRA account. You're getting a 33% return. Your buying power effect, though, is only $500. So you're getting 250 whatever, or 270 something % back on your margin. That's a really nice, efficient trade. There's really no need to do anything else. That is a lovely, lovely trade. All right, and if it wasn't so long-term, I'd put it in the options opportunity portfolio. I mean, you don't get much better trades than that. Now, if you want to get more aggressive, being that they're at 9, you could take this 8 call for, oh, it says 410, but all right, let's say 410. All right, so you take the 8 for 410, you sell the 12 for 240. All right, and what's that? 70. So that's $1.70. All right, so you can do the 8-12 spread for $1.70 and sell these calls for $1.30. So now you have a 40-cent. You're in for net 40 cents on a $4 spread. Is that right? That's 8-12. Yeah, 8-12 on a $4 spread. That's already in the money. If they go, so all they have to do is get to 12 by 2018, and you make 10 times back on your money. It's not hard. So that's a more aggressive way to play. But frankly, again, it's so obviously cheap to just sell the puts. I don't even know if I'd want to complicate the thing. It's too good. If it gets lower, then here's what I do. Let's say I have an allocation. Let's say I don't mind owning $10,000 worth of FCX. Okay, so at 370, I mean. So at 370, I'm willing to own 3,000 shares of FCX. So I would sell 15 contracts right now. So I'm committing to half of that amount. I sell 15 contracts right now and collect my money. If FCX goes lower, if it goes higher, I just keep the money. So what? I get my $2,000 bucks. But if it goes in any way, if it goes down to like 750 or so again, then I'll double down on my sale, and then I'll buy the bull call spread because it'll be cheaper. And in fact, I can probably buy the 5-10 spread for the same price because if FCX drops down, and then I would get more aggressive. But to start with, I mean, they're basically handing out $2,000 bucks for free. It all goes to portfolio management. Okay, I have a portfolio, like a long-term portfolio. I think we have FCX in it, so it's not a thing. But in the long-term portfolio, this is the attitude. It's like, okay, well, we've got $800,000 sitting in the bank. We'd like to spend it on something, and we're looking for bargains. So I say, well, okay, so my allocation blocks in the long-term portfolio are about $50,000 each. It could be, actually, it's almost 100 now. But an allocation block is at least $50,000 bucks. So I have no problem at all committing to a $15,000 purchase. So I would sell 50 contracts. That gives me 5,000 shares of FCX at 370, right? So it's about $20,000 bucks. So I would sell 50 puts. I would collect 50 times $1.30, which is $7,500. No, $6,500. And what's the cost? So what am I really doing? As we saw, the margin is nothing, so that's not even an issue. So what am I doing? I'd be collecting $6,500 in exchange for promising to buy $20,000 worth of FCX if it goes to 370. It's a no-brainer. Why would I not take $6,500 for that promise? I want to buy FCX for 370. I'd love to own it for 370. There's no reason not to do that trade. Why? What's the point of having a portfolio if you're not going to say, I'll buy it for that price? Okay, like imagine it was a Volkswagen convertible. Okay, you might not be a Volkswagen person, whatever. But let's say a Volkswagen convertible is like a $25,000, $30,000 car, and someone says, if this car were $10,000 brand new, would you buy it? Fully, same car, all insured, whatever. And I'll pay you. In fact, I'll pay you $5,000 to promise to buy this car for $10,000. And you're like, what? Is that real? Because it's like, why would you not do it? You're like, you don't need the Volkswagen. You don't care about the Volkswagen. But you know what? It's a freaking Volkswagen for $10,000. That's what this is. If you understand the value of a company, that's exactly what this looks like. The same obviousness of the value of a car. Okay? If somebody, let's say it's one of those, like a nice washing machine, right? A nice washing machine is like $500 or whatever. I don't even know what they cost, $1,000. But let's say it's a really nice washing machine, and it's usually at least $500, and someone offers it to you for $150. And they say, okay, I'll pay you $50 if you promise to buy this washing machine for $150, brand new out of the factory, fully warranted. And you're like, you might say no because the logistics of owning the washing machine, and you say, well, who am I going to sell it to? Blah blah blah. Stocks aren't like that. Stocks you can immediately sell They are liquid. So the only reason you wouldn't buy it is only because you would have to sit there and say, well, I think that at 950, it's not worth 950, it's really worth less than 370. And if you think that, then move along and get another stock. But if you are looking at FCX and thinking of buying it at 950, then selling those puts is beyond a no-brainer. It's not even a question that you should do something like that. I mean, when you see things like that, your portfolio should be full of stuff like that. And ours is. This is why we have such great performance. Okay, because we don't do it often. Is that the long-term portfolio? Here you go, up 75%. And we're using $1 million in margin. See the margin required, $1 million? This thing, by the way, though, it only calculates a 1-to-1 margin for cash. I'm not for cash, for your portfolio value. So it shows a negative value, but really we have like a we have a $1.67 million thing. So we really have about $600,000 in margin remaining. So do we have FCX? No, we don't. So there you go. That's a long-term portfolio play. So let's sell 50 of those in the long-term portfolio and collect the money. All right, that is an official trade. Unless we have it somewhere else. Do we have it? Oh, here it is. I'm sorry. We do have it. Wait. We already sold the January $4 puts, and we sold we do like this trade. We sold the $5 puts, oh my God, for $2 at one point, back in 226. Oh, well, that was when I made that trade for the money show. See, when we did the money show, it was like around 122 or 2, one of these days. We sold these puts, because how could you not? That's the point I'm making. How could you not sell those puts? And look at the bull call spread we did, the 1.550 bull call spread. It seems ridiculous now because they're at 950, right? But that's the point, because when it was at $5, when FCX was at $4, okay, I was banging the table and telling people to buy it. Because to me, that's a Volkswagen for $10,000. I'm like, it's a freaking Volkswagen for $10,000. It's a $30,000 car. Why would you not buy it? And I feel the same way. If you understand the stocks that you're trading, you feel the same way. It's like, how can you not see the value of this thing? You can't let other people dictate how you feel about a stock. And these are other people. All these people who sell here, all these guys are other people. They're not you. You've got to know what something's worth, and you've got to decide what you think something's worth in the long term. We weren't ambitious. We capped our gains at 550. We were very conservative in our play. And look at how much it's up already. It's up, okay, 98 minus 6, so that's like 3,000, 5,000, 6,000, 65, about $7,500 we made since 122. And that's 20, that's not even 50. Right now I'm saying I'd do 50. It's total 40. It's actually right around the allocation amount I would have said. In fact, the long-term portfolio was smaller then, so it's exactly the right allocation amount. So now I would do 50, then it was 40. But I did exactly what I was just saying I would do, because it was cheap and we did it. What are we doing here? See, we have more cash here than we have actual value of the portfolio. It's pretty funny. So why are we using so much margin, though? Because we do this constantly. Because even, it didn't show up here. That's why I was confused, because we didn't have FCX and these short puts up here. Because it's not a naked short put. We actually added a bull call spread to it, so it moved it down to this category of spread. But it's a lot of them. We do this a lot. Look at lumber liquidators. In fact, the only change we made to the long-term portfolio in the past 30 days, other than a rolling thing, other than the March expirations, the only change we made was this one trade where we rolled the $13 calls to the $10 calls and added 10 more. We were 20, and we rolled down, and then we added 10 more. And now look at them. Now we're up $6,500, $6,100 on those. From when? From 318, from like 2 weeks ago. That's the only move we made in the long-term portfolio all month. Because mostly we do nothing, because mostly We have 27 short puts, and that's not counting the FCXs and the other stuff that's down there. So we have 27 naked short puts where all I'm saying is, oh, you want to sell me this? You want to sell me Alcoa for $13 minus $2.45? I will buy that. All right, for like $10. I will buy that, even though it's under $10 now. I don't care. If it's still under $10 in January, we'll talk about it. But right now, that's to me a good target. Here's Anthem, $110 less the 6 we sold it for is $94. What's it at now? $144. Oh well, that one took off like crazy. This will obviously expire. Seriously, you can still get $430 for that? That's crazy. The 110 puts you can still get $430 for. I would still do this trade. Here's Sotheby's bid, and again, 35 minus 7 is 28. Where is it at now? 26. I'm not worried about that. We collected all this money, though. All this money, 4, 3, 7, 8. Well, this is a lot of freaking money. We collected all this money. We got it in our pockets, and the only downside to us is that we own these stocks. If they get that cheap, then we own them. I don't have a problem with that. This is how we buy things. Oh, look, we do have some Harley. I forgot about that. They're going through a rough patch. That one I'm kind of wondering about. They got a really sour note just the other day, and they turned down substantially. So that's our portfolio. We're happy with these things. These are the prices we want. We want to turn these short puts into these long positions down here. So this many, how many positions is down here? Let me see. 20. We have 20 actual positions. We have, we have 6 of these too. We have six dividend stocks. These are all ones that we get dividends on. We have 20 option spreads. Here's just a bull call spread. And then we've got mostly short puts. And when one of these short puts, there's two things that can happen with the short puts. Either they expire worthless and we keep the cash, and so every month we do a trade like FCX and we put another few $1,000. We try to do at least $5,000 a month in short put sales. And every month it drops another $5,000 in cash. And by the way, so what happens is by the end of if we do $1,000 a month for the rest of the year, we'll end up with like 36 of these things, right? That's the correct way to do it. We have 36, but then in January this year, half of these things are going to expire, and then we'll be down to 18. Then we start selling again. That's how the cycle works. There's always 1 year is always in play. That year expires pretty much all at the same time in January, and then we add another year's worth as the year moves along. So we're constantly adding more, and we build up a larger and larger margin requirement, of course, as the year progresses. But then when we get to January, we purge a ton of them. That's how this thing works. And that's how we build that portfolio, though. It's all based on promising to buy things when they're stupidly cheap. Look at this. We sold the CLF January, the 2018 $4 puts. We sold them for $280. That's net $120. It's at $297. It's still $262. That's as stupid as CLF as FZX is. It's net $1.20 on a $3 stock. I don't know. Again, it goes back. It's a Volkswagen to me. It's like, why would you not buy that? It doesn't make sense not to buy it. It's one thing with these expensive stocks to say, oh well, who knows what could happen and blah blah blah. But we talk about a stock, the worst case scenario. If you do 20 of these, and let's say it's $250, just to make it easy. So you do 20 of these, you get $10,000 in your pocket, and you're promising to buy $8,000. You're promising to buy $8,000. Wait, that's right. Jesus Christ. Wait. If you do 5,000. That's what it is. If you do 20 of these contracts, you're going to collect $250 a contract. It's $262. But I'm trying to round it off. You collect $250 a contract. That's $5,000 in your pocket. You're promising to buy $2,000 shares of CLF at $4. So your promise is you're getting $5,000 now, cash in your pocket, and you're promising that in 2018, if CLF is below 4, you'll buy $8,000 worth. You'll buy 2,000 shares for $8,000. You got 5 in your pocket. So the worst thing that can happen to you is you take $3,000 extra out of your pocket and buy it. So your worst case scenario is that you're going to buy 2,000 shares of CLF for $3,000. That's the worst thing that can happen to you. The best thing that happens to you, you keep the $5,000. Why? Why would you not do that? See, I go through every day like this. I mean, that's to me, things are just so obvious, and sometimes I have trouble conveying it. It's like, because people say, how about this or that? And I'm like, well, why would you do that when there's such better trades out there, when there are things that are just completely simple? All right. Oh, what happened? Well, we're up to the Fed. How needs to sell service lines is not about the value of them. I hope they don't merge personally. I could care less. I'm not a big Howe fan in the first place, but I'm a big BHI. I wasn't a big BHI fan or a big Howe fan, but when Howe signs a deal saying we'll give you $3.5 billion if the deal doesn't go through, I became a huge fan of Baker Hughes. Because I'm like, okay, so either we get bought for a lot of money or we get $3.5 billion. Again, it's a no-lose situation. And again, I almost can't convey properly how good of a deal that is. I don't understand how anybody could possibly sell that thing down to $40. There's no math in the world that I can accomplish that justifies this. That's stupid. It's still stupid. This is still stupidly cheap. Even if the deal doesn't go through. No, not to say that the thing won't crash if that happens. The thing, we could go much lower, but it's all going to be panic, and I'll be a big buyer at that point. Governments are good at building wars in the military. Well, obviously, that's also what got us out of the Depression was World War II, but that was Keynesian economics also, though, right? Spend money, build stuff. We built tanks, we built bombs, we hired soldiers. It doesn't matter what you build as long as you build something. It's nicer to build bridges. And that's what that's what we did in the 50s and 60s. We built highways and we built all the suburbs and all the American infrastructure. That's good building. That's what laid the path to prosperity. But Europe, I say we, by the way, I'm talking about the whole world, because the rest of the world will spend their money rebuilding the world. Everything was being built back new from being bombed out all over the place. And that was a huge those were huge projects, and we accomplished great things. And the governments at that time, yes, they went into some debt, but that's what boosted the world into the modern age. I mean, you got to say some things are worth it. FCX spinning up the gold and copper side and keeping the oil. Really? That's a terrible idea. I didn't know about that. I don't like that, but I mean, I don't mind owning the pieces when they spin them off and then decide what to sell. QE is Paul Q. No, it isn't. No, Krugman doesn't approve of it either. Krugman's a Keynesian. Like Krugman is a Keynesian. I'm a Keynesian. It's been perverted. People don't even know what Keynesianism is anymore. Why not sell the 8s instead? Because I prefer to have the cushion. I'd rather sell more of the lower strike one. How do you decide how deep in the money you buy your bulk call spread? I look for the best deal. I look at each price, and I feel I know what something's worth. So I'm thinking FCX, could it drop 50%? Sure, it could drop 50%. If oil falls back to 30 or something like that, and gold falls up, the dollar gets strong, then they can get screwed again, okay? And they can go down for a long time. But 5, I'm real comfortable with 5. 8, 8 can get broken. Why should I have, I like to own things that I don't look at. Especially in the long-term plays. I don't want to fiddle with them. I don't want to sweat over them. I don't care. Like, I look at the long-term portfolio. This happens all the time. I don't care. I write when we do our reviews, I mostly write, don't care, on track, fine. That's how we go through these things. Fine. Because it doesn't matter. It's 2 years away. Actually, not two. Most of them are 1 year away. See how many 217s there are. But, so they're 1 year away, they're 2 years away, whatever. But the point is, they've got tons of time. They're generally mostly in profit. The ones that aren't in profit, I'm not particularly worried about. Here's Expedia, right? Oh, I wish we could own them. They're a good one. See, and they're actually cheaper than where we sold. So that one we aggressively sold, and we have a problem. We got to add these. Nice. We should add more of those. I'm gonna go through the long-term portfolio probably this week or something. Oh, the minutes, right? Thanks. All right, let's see what they say. Yawn. Well, actually, I don't care what they say. Let's see what the market thinks. Nope, doesn't like it. You can tell right away. Unhappiness. All right, so here you go. Shorting lines, very obviously, 17.6, 2050, 45, 15, and 1100. And you can't, who knows what's going to happen right now, but if I was going to start shorting, I would probably go with 2050 on the S&P. That's going to be tough. Once they go below it, that's going to be a good stopping line. I would have liked 17.6 on the Dow, but obviously, well, we know that, don't we? 17.6 is our must-hold line on the Dow. 1100 on the Russell is probably going to be the most fun to short, but it's also the most dangerous if it pops the other way on you, so that's kind of annoying. Is gasoline coming back? Oil's still down. The dollar, where's my dollar? There's my dollar. Dollar down, so obviously, so without even looking, I can tell you that these minutes are disappointing, that the Fed is generally still leaning weak, still leaning to easing. And I don't know why the markets would be disappointed by this, though. I don't see what the point is, unless they made some negative comments on the economy. So now let's find out what they did say. Fed minutes. NUGT. That's this, right? March 15th, blah, 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 blah. Okay. Blah, 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 blah. Report on developments, deputy manager followed. Oh, who cares? Okay, staff review of economic situation. Information review suggested labor market conditions are continuing to improve. Pace of expansion is picking up. This is incorrect. Now, here's the thing. The only bad thing about doing this on Wednesday is I'm not going to be able to sit there and do my highlighting, which is kind of useful. But here, let's do a live highlighting, okay? The pace of expansion in GDP was picking up somewhat from the previous quarter. This is wrong. We now know this is wrong. They just downgraded their economic forecast of GDP. So since March 15th, the situation has deteriorated in the past less than 30 days. So now, you have to take that. All right, let's get a calculator. That's a good idea. Here. It's like when you play blackjack and you're counting cards, right? You assign point values to things. So let's say we have a 3-point system. And it's either very bad, very good, or neutral, right? Or let's should be 2 points. No, very bad, medium bad, neutral, very bad, very bad, neutral, or whatever. And let's call that dovish. So the GDP coming down would be a 3, very dovish. Okay, so that's the first thing we see is that's changed since this. Consumer price inflation is still running below the objective. That's still true. Restrained in part by decreases in energy prices. That is no longer true. Ah, you bastard. Really, every time I touch it? So, energy prices coming up a little bit means what? That's going to be more bearish, more tightening, more hawkish. So but not much because it barely moves. So let's call that a -1. There we go. Now, energy prices survey based on long inflation, expectations a little change, recent months, market inflation. Non-farm payroll increased in January, February. Yes, that's still true. Unemployment rate declined, still true. Remained labor force participation rate. While both labor force participation rate and employment ratio increased, still happening. Share of workers employed part-time, edged down, about the same. Rates of private education, private jobs rose in December, 4-week average. Compensation per hour non-farm increased, but that's not happening. That's going to be a +1. Okay, because we're not seeing a big rise in payrolls in average compensation. Employment cost index is fine. Average hourly earnings for all employees increased 2.5%. Okay, fine. Industrial production increased January, did not increase. Let's give that a +2. Okay, that went down. Manufacturing output rose. No, not really. I'm not saying not really to what they're saying. I'm saying since then, not really. Reversing declines in previous months, so we went back to the weak output. Output of utilities moved up sharply. Demand from heating rebounded. That's not really true. I'm going to have to give that a +1 at least. The +1 being more dovish. Mining output was unchanged following 4 months of declines in drilling activity. Okay, now that's turned around. Let's give it a minus, only a little, but let's give it a -1, a little bit more bearish. Or hawkish, I keep saying bearish, sorry. Automaker schedules indicate manufacturing production readings. New orders are pointing to modest pace of gains in output. Yes, orders still going well. Information drilling activity, still terrible. Okay, that's fine. Growth in personal consumption appears to pick up. No, sorry. Going to give that a +1, more dovish. And the nominal retail sales, PCE, will go unchanged. Recent readings on key factors influence consumer spending generally points towards solid growth in PCE. I don't think so. I'm going to go 1 on that. All right. Gains in disposable income picked up in December and January. Household net worth supported by equity followed declines. Further increases in home values. Home values flattened out. Oh, God, I got to go another +1? This is getting bad. All right, +1. See, now, if this were a blackjack deck, we'd have to be increasing our bets. All right. Consumer sentiment remains at an elevated level. It's still pretty good. Housing activity is consistent with gradual recovery. I already +1 that. Status of multifamily, who cares? Real private expenditures, intellectual property products appear to be increasing modestly. Nominal shipments is on defense. Nominal spending structures, drilling. Then I'm just going back in my mind of all the different things we've read in the report. Limited data available suggests inventory investment continues to decline in the early part of the year. Nope, going to give that a -1 because we are seeing a pickup in corporate spending in just a tiny bit. Growth in real government purchases appear to be modest in the quarter. Federal government spending in defense was soft in February. That's probably continuing, but that's because of the lack of anybody agreeing on anything in Washington. That's certainly not changing. The trade deficit widened. No, it hasn't really widened. So let's see. If the trade deficit is narrowing, then what does that mean? More out, and that's, I guess that a -1, I guess. So that's a little bit more hawkish because obviously a sign of economic improvement. I mean, we don't necessarily want our trade deficit to widen. We're in a weird position in America. We like having an imbalanced trade deficit. Unlike almost any other country. Imports are slightly, because we consume so much internally that it's not an issue. That's why people look at our trade numbers and make a big deal of it. But nobody consumes the way we do. So the amount of trade that we do with an imbalance is nothing. It's just an indication of what we do. Plus, you have to realize, it's an odd thing, but you have to realize, like, if you have 50 million people have an iPhone, it's $1,000. It's $50 billion worth of iPhones alone count as a trade deficit because we import them, even though we made them technically. We made them, they just assembled out there, and they end up showing up as an import cost. So there's all kinds of silly things in the trade numbers. Net exports is subtracted from real GDP growth, as it always does, and that will continue to weigh on growth short. Consumer prices increased 1.4%. They're kind of subdued. CPI has been the same a little bit. Got to go dovish. One more. Survey measures long run foreign real GDP growth slow for sure. That's obviously happening. Japanese economy contracting still happening. So there's nothing here has changed. Further softening in China. China, I'm going to go -2 on China. They had some very good numbers today and yesterday. They had a lot of improved numbers. Not that you can trust them, but you got to take it on face value for now. Let's see. Concerns about low inflation, speed monetary policy, staff review, financial markets turbulent. Oh, and the market went up. That's going to be a +3. minus 3. Stock market drastically changed since March 15th. You know, well, because of the Fed, it's a funny thing. It's because of what they did, but what are you going to do? I mean, that's the fact. Here's the Fed meeting, and here's our reaction to it. So everything they're saying about the market that's a negative is completely reversed. That's what a 3 is, right? If I'm going to call something a 3, that's what a 3 is. Complete reversal. Okay. Stocks rose, equity price volatility, yields on 5 and 10-year treasuries. Now those are back in. Continued risky assets, yes, same thing. The yield curve, who cares? Median S-match equity market indexes, we know that. Financial conditions for investment grade non-financials is the same. It goes worse. Okay, it's a little dovish. Bank situation's gotten a bit worse, so we'll add 1 for that. Commercial industrial growth was strong. You know, this collapse of M&A is not good for the banks, so the Fed's going to be less likely to do something with the banks having any kind of problems at all. Financing conditions for commercial real estate tightened somewhat. Lending conditions in financial real estate during the intermeeting period. Foreign financial conditions. They just talked about that before. Over the mid-September, financial market, blah, blah, blah. Okay, nothing there. Economic outlook forecast prepared by the FOMC. Here's very important. The GDP in the first half was projected to increase a little more slowly than prepared in January. Now, it's much more slowly now than it was here, although the estimated GDP growth was revised up. So here's a mistake. They're wrong. All right, so we're going to have to go, unfortunately, we'll have to go +3 there. Damn, just when we're making some progress. All right, so that's bad. Real GDP was expected to increase slightly faster. Wrong. Largely reflecting somewhat higher projected path for prices. Wrong. The staff continued to project GDP to expand somewhat. Wrong. Okay. Wow. Unemployment rate gradually declined further. Hasn't happened. Also wrong. Wow. Therefore, I have not seen it been this off in a long time. Staff forecast for inflation first half of the year revised up somewhat. Wrong. Staff continues to project inflation. I'm sorry. We're going to add at least. I got to add 1. There's no way I can not add 1 for that. Beyond 216, the forecast was lower. The staff viewed uncertainty around March. Projections for GDP growth. Inflation in the last 20 years. Forecast for GDP is tilted to, the risks to the forecast were seen as tilted to the downside. That was correct. Reflecting the staff's assessment, the need of fiscal policy, we're not doing anything to actually fix the market. That's true. In addition, global prospects were still seen as important downside risk forecast consistent with downside risk. The staff viewed the risk to outlook as unemployment as skewed to the upside. Wrong. The risk of the projection inflation was seen as to the downside, reflecting Okay. Current economic conditions. Participants' predictions. Outlook. Participants view the information. This is nothing. Household spending increases. Just a review of that. Okay, so the bottom line is, if anything, this is more dovish. Now let's see. Here's what they care about. Oh God, look at all this. Committee action. Okay, and then you want to say, well, yeah, it's a long thing. You really want to then read and see how many people. When it says several participants noted softness in the index and signs that sluggish growth would continue. Several were dovish, not most, several. So there were more hawks than doves at this meeting. That's the kind of clues you want to look for. Now, those guys were wrong, and so again, everything is pointing to more dovish, not less dovish, though. That's a big number. That's a big differential. So like I said, we were playing blackjack. This would be the time to, bet heavy. And the market does play blackjack, but it doesn't do enough to justify the giant. I mean, here's the thing: you can't go by where we are today and say, "Oh, well, that's dovish." Okay, no, because we've already done this. We've already gone from 180 to 205. That's 10%, right? We already had a 10% move at least. 10% would be 10% is 198. Sorry, so it's like a 15% move from the bottom. I say let's look at, in fact here's the target. Let's look at this 200 line or 2000 on the S&P. That's going to be where? Right about the 2000 line, yeah. So let's assume that we could actually fall back to the 2000 line because there's not enough here to justify it. A 10% move up on that data, sure, but not a 15% move. We're too high. But this is why we were short in the first place. Now the question is, CNBC right now says, Musk, it's probably unwise to short Tesla stock. They're quoting his tweet. It's such a scam. I'm sorry. It's just, this thing is a total, we're participating in a complete scam. It's just a lot of bullshit where people try to trick you into moving your money around. That's what most of the market is. So just my little side statement. Oh, these are coming down now. Damn it. All right. So, here you go. You just done the 2050. You can still play any of these. Frankly, it's not such a bad thing. So let's do that. We like to make some money for you guys. So let's take. All right, we'll take the Russell because I can assume it's going to go down more than it's going to go up, and I'm going to short it here. Thank you. Now I intend to scale in. Whoa. The hell. Let's try that again. All right, so I'm intending to scale in at 1099. Oh. All right, we'll take that one if we can. There it goes. Okay. So now we have one short of basically 1099. I will be thrilled to add two more at 1100. I'd be thrilled to add more. But for now, we'll just go with that one. None of this affects natural gas. Let's see what the dollar's doing. The dollar went up and down, so it's back down here. It's dovish. It's clearly dovish. There's no reason the dollar should be any higher than it is now. It should not be at 95. It probably shouldn't even be at 94, frankly. There's nothing there that's strong dollarish. So still, on the whole, though, I'm expecting a bit of a sell-off, but this is still a dovish Fed. We're not going to get a big sell-off, but I expect a little bit of a sell-off because how do you support a 15% move up on those minutes? When they're clearly wrong, the Fed does not know what's going on. They do not understand the situation. And silver? Oh, silver already popped up. Damn it. So silver already jumped up. Gold is still probably got to move up in it. But clearly this is dovish stuff. So having taken the Russell trade, 109.95. Remember, I want to add one. This is where I want my average to be. So when we test 1100 again, I'm going to want to add. But these are bad signs. We're over 2050 on the S&P. Let's take a look at the. What I did. I know that's the wrong symbol. NG. Boy. Hello, brain. NQ. There we go. All right. So keeping an eye on this thing. Ideally, I'd like to have 3 contracts at about 109.95. But I don't want to add one here. I want to get it higher if I can, especially because I'm not. Everything's moving against me right now. This is over 2050. That's not good. So I'm not getting all the good signs that I want to get to be aggressively short. So I'm just going to wait and see how my one contract performs. But again, the minutes are dovish, but not in any spectacular fashion. I mean, clearly the Fed's not tightening. But the reasons the Fed's not tightening are bad. Because the economy's worse. Because things that they thought were good are not there. And the Fed has already said they really can't do any more about it. It's up to the governments now to start putting some money to work in the economy. And that ain't happening. Oh, here it comes. And this is what futures trading is. It's mostly waiting. you gotta wait and get your price. So right now, let's do that. We'll just sell up at 1099. I'll do one there. Oh wow. And we pop right over. So I'm going to want to do one more sell if I can. Well, now my average is 109.93. I really wanted 2 contracts, so I'm not looking to get out. I'd rather get higher. I was going to say, discipline-wise, I should be buying one back here so that my basis is higher. But in reality, I actually wanted to have at least 2 or 3 contracts, so it's not where I want it to be yet. I wanted to buy another one Should have just bought that other one. It would have averaged out properly. I wanted to get my average up to 109.95. Oh, here we are, 11100. See, I'm not getting a good sign here, though. Let's get the Dow in play. Remember, you always want to look for confirmation signs. So the Dow is going back up. Nothing is going in my favor right now. The Dow is going back up. He's got the only significant resistance line is the 1100 line here. I'm waiting for these guys to catch up and hit their resistance points, and then hopefully we can all start going back down. I expect a little bit of selling into the close. I expect some selling in oil into the close also. So if we look over at oil for a moment. So it's a weird thing. Like I went short, but I would like it to go higher first so that I can buy more at better prices. Here's oil with Brent. Oh dear. Wow. There's nothing in that Fed report that should make oil and gas go up. There's really no. Oh, here you go. So now oil is going to be a great time to short it coming into the close. Or you can just short Brent, really. That $40 line is not going to break on Brent, which means that, you know, right here you can start shorting at this spot, which is $38 if you barely hit it. But so right now we're at $37.80, and that makes a good short on oil. So that, in fact, I like that one. Let's put that in, and we'll just keep an eye on that instead of the Dow. So that's going to be CL, the current contract. I'm going to call it a short right here. Ah, you bastard. Come on. There we go. Thank you. Oh, please. Unfair. Oh, look at that. Come on. And the reason is profit taking, by the way. When IMEX closes at you have to know these things. The NYMEX closes at 235. Okay, it had a 5% run on the day. That's a lot. Therefore, into the close, there's going to be some people who say, "Let's take some money off the table." Oh, there it goes. Now I got my fill. And again, this is why you don't chase. If you don't get the money, if you don't get the number you wanted to get, don't chase it. It'll probably come back anyway. That's the way these futures work. So what we have right now is we have two short contracts on the Russell. And it's just slightly over my 1100 target. We have one short contract on oil. That's where we're playing it. So now let's get back to some questions and see what everybody's talking about. Whoops. SCX spinning off gold. We talked about that. SCX puts it in the OLP, are they? Really? Do we use them to pay for something? How is that thing doing anyway? Ooh, 27%, not bad. SCX. Yeah, oh, those, yeah, okay. Well, again, it's a no-brainer. How could you not? That's, you know, at 950, the one we were just looking at, I wasn't as excited about, but here, it's like for freaking $2 for the $5 puts. How could you not? That's the same. That goes back to the same thing. I'm very consistent. Even if I don't remember what I did, I'm still consistent with my actions. It's like I looked at that and said, well, there's a way to add $1,000 to the portfolio. I mean, how many do 5 contracts, right? Yeah, 5 contracts. We sell them for $2. We get paid $1,000 to promise to buy FCX for $5 in 2018. It's like free money. It's a small portfolio. It's a $100,000 portfolio. I'm going to take 1% of my portfolio to promise to buy something really crazy cheaply. Why would I not do that? FCX versus AA, is that a question? I like Alcoa, and I like Freeport, but I think Freeport probably is stronger. I mean, the breakup's going to be a pain in the ass. Alcoa is spinning off their unit too, though, so everybody's breaking up and spinning off and doing weird stuff. Tesla says, this is the weirdest thing. Tesla says they're not going to make their Model 3 out of aluminum. They're going to make it out of steel. I don't understand how that's even going to work. My understanding of physics is that they aren't going to be able to get 200 miles off a steel body car unless they're, I don't know, I'm lost. I mean, engineering-wise, I don't see how they're pulling this off. You know, the reason the Model S is so good is it's made out of like die-cast aluminum. It's like, you know, it's very lightweight, but also very strong. So it's a great car. It gives you great performance, so on and so forth. Chevy's doing, Ford does it with their F-trucks too. The trucks are made out of aluminum. That's good for Alcoa. Okay, so long term, I still think there's a good demand for that. Okay, they lost the aircraft business to composites. They lost a lot of aircraft business to composite materials, and that was a huge use of aluminum. You know, in the previous lines of airplanes, that was a huge use of aluminum. They lost that. They lost a lot of canning business too. Of course, a lot of stuff comes not in cans anymore. So a lot of negatives on aluminum, but cars makes up for everything. Okay, they start making a lot of aluminum cars, and all of a sudden the demand for aluminum is through the roof. So that's the thing on there. FCXO is the nice base materials. You know, they're breaking up into pieces, but it's all base materials that we want to be in. Gold, you know, you got gold, copper, and oil. So these are all things that we think long term are going to be good. The DOJ officially filed suit. Okay, that's weird. The DOJ officially filed suit. They're still going up. I would think people would have a worse reaction to it. Oops. BHI. Huh. Isn't that funny? Okay, but it's the same thing though. I could care less if they file a suit. It's not an issue. In fact, maybe people feel it's better for Baker Hughes to just get the cash than it is for them to have the deal done. Imelda, hi, just got to the webinar. What portfolio are you looking at now? I'm in the OP and want to know what to do with Baker Hughes. Nothing. What's wrong with it? Here's the options opportunity portfolio. And what is Baker Hughes? Okay, nothing. We have the 50. First of all, it's even. The spread is even at the moment. That's number one. The short puts are the $50 puts 2 years from now. I'm fine with those. I think that's a perfectly good target. The spread is we own the $40 calls, and we make all the money up to $60. This spread can turn back $20,000. Currently, the value of this spread is, let's see, 76 minus 13. So it's like a $6,000. Currently, the spread is a $6,000 credit if you take it, if you start from scratch, and this spread can return up to $20,000 if Baker Hughes goes to 60. Now, if Baker Hughes gets bought, they're going to get bought in the mid-50s. So you get $15,000 right away off your negative $6,000 cost now. So that's a $21,000 profit if the deal goes through. If the deal doesn't go through, I still expect them to be at 50, in which case you get $10,000 back off your negative $6,000 trade. So what would I do? I would frankly, the only thing I would do with this trade is buy more of it. It's inappropriate in this portfolio for us to promise to buy more than $50,000 worth of Baker Hughes, so we're not going to. But there's nothing about that trade I don't like. Could you sell it to CLF 2018, $1 puts for 40? You could sell. The $1 puts 50. Yeah, well, that's a great trade too, obviously. I mean, there's nothing wrong with that. It's crazy, isn't it? It's like insane, the kind of, you know, when you look at these things, you see some really unbelievable prices. Now we talked about setting a price though. Like if you see that, oops, CLF, right? Yeah, look at that, 55 cents, even 53 cents anyway. So you can sell the $1 puts of CLF for 53 cents. That's a bankruptcy pricing. I mean, they're saying it's going to be it's $2.90 now, and you're promising to buy it for 45 cents. That's kind of kooky, right? In fact, or you can sell the 50-cent puts for 26. It doesn't matter how you do it. The bottom line is you can collect 50% of whatever you promised to buy at this price, and at this price, and at this price also. See that 90? That's even better. But my logic in going with the $3 puts is just the simplicity of collecting. For me, I'd rather collect $2 and be done with it than mess around. My net is still 120, and it's not, the 120 doesn't bother me. Again, it goes to the value. It's like I'm very, very comfortable owning them at 120. So I don't need to go lower. I would rather have the money. I'd rather just have a normal amount of things instead of doing, you could say, yeah, you could do 100 of these instead. And it maybe works out about the same. But you're also more flexible with the higher ones. And also, by the way, also they'll pay you better. These things will hold their premium for a long, long time. These guys, if Cliff jumps up to like $6, this thing will drop down to, this thing will drop from 3 to 50, or from 2 to 50, and you'll have 75% of your money collected, and you can get out of the trade and be done with it. So that, there's reasons I like something better than something else, with various reasons. Oh, how are we doing here? A little sketchy on that one. Oil's coming down a bit. All right, we'll see. How do you see more oil moving approaching OPEC? I think oil's going higher. We just took a bullish in the 5% portfolio also, in the options opportunity portfolio. We just took this USO spread. Was that? Yeah, here, 4-1. We already had these calls. We added the 710 bull call spread, which currently is about the same price, at 220 minus 95 for the 710 spread. So here we have 2200 minus 1000 is 1250. So for 1250, we have a $3,000 spread on UCO. So that I think is a great play. And actually, we sold the USO puts to pay for the original UCOs. Where's USO? There. We sold these 850 puts a long time ago. We collected $1,100 to pay for it. It's much, it's a different trade now. But at the time, that's how we funded the purchase of these UCOs. So this original spread was we bought, they aren't together because this system doesn't put two different symbols together, even if they're the same trade in your mind. But we sold those USO puts to pay for these July calls, or partially pay for the July call. That was our original spread. And so far, July calls are still the same price, but the USO puts have dropped dramatically. USO puts are, where'd they go? Here. So they were $1.10, now they're 44. So they're up 60%. The other guy's flat. So part of the trade is flat and part of it's up. But that's fine. We're in good shape there. We expect UCO to hit 10. That'll make these things $5. They're $3.65 now. It's not a huge upside, but it's nice. It's good spread. These guys, though, these are going to make some good money because this came in. This was a $1.25 spread. It's going to pay $3. What was our short price on CL on the one we just did? It was $37.79. So here we are up $120 already on that one. So you see here we're up 120 here, and here we're up $30 after all that trial and tribulation. And we'll see how we finish up in the lower oil. Oh wow, did I miss that, or is that just happening? No, it's just happening. Okay, so that's how we make, because we made a quick 150, which is not, it's okay. I mean, for me not paying any attention at all, it's not bad. The aluminum car needs to be grossly overbuilt because aluminum doesn't have an endurance limit, so you have to design it to work for life. Steel has an endurance limit. It can be built for an infinite lifespan while much weaker. Okay, yeah, well, I mean, obviously there's going to be trade-offs, but it's a weight thing, isn't it? I mean, that's the key, is the aluminum cars are just much, they work better for electric because the weight is everything on an electric car. Nugget, isn't it wise to sell the 2018 puts? Time decay is a problem. I mean, yes and no with Nugget. It's I don't play it. It's an ugly little ETF. It's an ultra on gold. NUGT. And yeah, I mean, wait, did you say sell the puts? Wait, that's not good. No. You never want to sell puts on an ultra ETF like that because they decay, and it's a big problem. The longer you give them, the more they decay. I mean, look, here. Oh, here's a good trick. All you ETF people should know this trick. Yahoo. Let's find the chart. If you want to get an idea of what the decay is, you go NUGT, okay? And you compare it, well, actually, I'm sorry, you really should compare it. It's a 3 times ETF, okay? You compare it to gold, GLD, and you compare it over the time frame that you're thinking of trading. So you do comparison, and now you do NUGT, okay? And, well, what the hell time? Oh, that's a day. All right. So if you look at it over a year, well, let's look at a quarter. Here's 1 quarter. And now look at what you've got here. Nugget is up 140%. Gold's up 15%. They're not even on the same planet. On a yearly basis, gold is flat. So for 1 year, gold is flat. Nugget is down 44%. Gold is flat. Nugget is down 44%. 2 years. Gold is down 7%. Nugget's down 85%. All right? So what's going to happen to you in 2 years if you sell puts? You're going to get screwed, right? You're almost certainly going to get screwed. Now, do you want to? Now, the problem is it's not so easy to sell calls. But these 3 times ETFs, this happens all the time then. In a flat market, they will decay on their own and just until they have to be reissued. They're constantly reissuing those things. They're the worst possible trading instruments, okay? Now, you could say, oh, it's a no-brainer to short it then, but of course you get massively burned to the upside. Right? Oh, in fact, what did we just see? Year to date. So if you say, oh, it's a no-brainer to short it, look what happened. So if you get caught on the wrong side of these things, they will kill you. But over time, they're going to decay, and they're going to decay drastically. And anything but a market that's going in their favor, they're going to decay drastically. So you want to be very, very careful trading these things, and that's why 99% of the time we don't. All right, if you want to short gold, if you want to short gold, take GLD and short the put and sell the puts. If you want to, if you want to be long gold, because GLD generally little decay but not horrifying. Even better though, if you want to be long gold and you want to sell a put, sell ABX. Again, another Volkswagen is ABX for me. They're way up from where they were. I mean, banging the table does not adequately describe what I was doing on ABX. I mean, I think everybody was sick of me talking about ABX all here. This was me banging the table on ABX this entire time. We're at $7, $8. And when it went down to 6 and everybody said, Bill, you're wrong. Oh, we're going to get killed. I went, all right, buy more. I could not possibly have been stronger about something than I was about ABX through this entire period here. Again, it's a Volkswagen for me. It's a $10,000 car. It's like, how could you not buy this thing? So even at $13, it's still great because you know what ABX has done? They did exactly what I said they were going to do. They sold off their assets. They used to have 140 million ounces of gold in reserve. Now they only have 100. They sold off 1/3 of their gold, right? But they sold off all of their expensive gold, all the stuff that cost them a lot of money to mine. All they have left now is the gold that falls out of the mine. That basically, they have gold that like just falls out of the sky. Those are the mines. I don't know where they are. But the gold they have left costs them like $700 to $800 to extract, versus an industry average of like $950 to $1,000. So they've got such an incredible price advantage, competitive advantage, and everything else. They're in such fantastic shape, and if the price of gold goes up, this stock is going to be the best stock you could possibly be. It's still a great stock, even though it's much more expensive. But again, where's my comfort zone? My comfort zone is $8. So go to ABX, and I say, can I still do something for $8 on ABX? And here I'm willing to be aggressive because I really believe in them. So you could sell the $10 puts for $1.60, and that nets you in at $8.40, even though the stock's at $14 now. So if I want to go with something like that, if I want to do gold, I'm going to say, well, why would I do gold when ABX is the most efficient instrument of gold that there is? Okay? If gold goes up 10%, ABX's profits 10% of 120 bucks, right? So if ABX is currently getting it out of the ground for 800 and selling for 12, that's 400 bucks spread, right? If gold goes up 10% and they get another 100 bucks ABX, that means their profits increase 20%. So they're highly leveraged to gold. But meanwhile, if gold goes down 20% to 900 bucks, let's say, ABX still makes money. Your gold lost money, but ABX, the company, still is able to make money with using the gold. And they're not being priced based on the amount of gold they have, because if they were, they'd be priced at, what's 100 million times, 100 million times 1,000 is 100 billion, obviously. And then plus 2 is, 120 billion, right? $1,000 an ounce, 100 million ounces is $100 billion. Yeah, so ABX has $120 billion worth of gold in the ground, right? All my older members know this because we've gone through this math many, many times. ABX. When I was trying to explain to people how you could not possibly not want this company. Their market cap is $16 billion. So their market cap is basically, 1/10 or 1/8 or whatever it works out to, but their market cap is ridiculously less than the amount of gold that they have. And the logic for their market cap being low is because obviously they don't get paid. The 100 million ounces of gold doesn't magically appear in the vault. They have to extract it, so they have extraction costs. But now that they've got their extraction costs under control, the market cap still is nowhere near in line with how much profitability there is on gold at that price. So if you take what you really look at is, say, 100 million ounces of gold at $400 an ounce is the profit they can make. So that's $40 billion. So their market cap at this price gold, they could be about $40 billion. Now they probably got about, I would say 20 billion in debt. No, they don't have that much debt anymore. They have 20, all right, so say 20 billion liabilities and forget the assets. So let's say it's $20 billion of debt, and I'm being very conservative. And so at least $40 billion at this price, at the spread that they're getting now for gold. So that should be, so this is a fairish price. It's a bit low. But in other words, if the spread goes up just a little bit, all of a sudden it's $50 billion, and the thing is grossly underpriced. So gold goes to $1,300 an ounce, and ABX is 50% undervalued. At $1,400 an ounce, ABX is 100% undervalued. All right, it's the kind of thing when you buy a stock like this, you just want to buy a survivor, because as long as they survive, anytime gold comes back, you're going to make a fortune. That's how you play the miners. You play them for the very, very long-term cycles. Ooh, 245 already? Holy cow. Get out of here. Uh-oh, what happened? Went to 1095. Oh, man. Seriously? Oh, that's not so bad. All right. All right. 370. All right. Yeah, let's take that. Oh, there's two of them. I forgot I had two of them. All right, so we got to do is buy that back. Thank you. And we'll buy that back. Thank you. Yeah, 350. And how do we do over here? 130. Let's wait. That was it though. That's a short too. I forgot. Okay. There you go. 130 plus 350 is $480. Thank you. Thank you. Come again next week. Hope you enjoyed the show. See, and how we've been paying attention. Of course, now look. Oh, this is a good example though. Look at this line. Right off that support. That would be, obviously that would have been the ideal time to take the money off the table at 196. So we didn't get an ideal exit, but I wasn't paying any attention at all. But if you are paying attention, yeah, that's a good place to take your profit, okay? When it stops going down and it starts reversing, you get the hell out. Especially when you already made 400 bucks or whatever it was at the time. All right, so that's all we wanted. We got the 9 minutes close. We got the little sell-off we expected. It's profit-taking. That's all it is. Okay? And we came over here, and the way I read the Fed, and the way we added it, and the way we looked at the minutes, that's where we came up with the decision. That's how you do it. You try to use these nice support lines, and when you get a nice line firming up in the futures, You take your money off the table and say, great, fantastic. And that's exactly how I like to play the futures. Nice, quick ins and outs, boom, done, go have lunch. That's completely paid for by my $500 here, or $480. Hey, that's what you do. And this is my retirement plan, by the way. When I retire, this is what I'm going to do when I retire. I'm going to wake up in the morning, I'm going to make a couple of futures trades. If I have a good day, I can go out and have some fun. If I have a bad day, I'll say, okay, I'll stay home today and just relax. I won't stop. I'll just go have a beer. But if I have a good day, I go out and have a really nice meal or whatever and have some fun. So it's just like play money when you retire. If you get, it takes practice though. But if you get good at it, and look, it's not hard. You just have to learn to analyze the market, think about the situation, and then pick your spot. There's a lot of waiting and a lot of patience involved, but that's all it is. It's like this is now, God knows how long the streak has been going since at least March. It went all the way, definitely every week in March and probably into February. We have not lost any money in the futures. Every time we pick trades, they've been working. And how long did that take? 15 minutes, a half hour? All right, so there's your salary. It's not bad. It's a really nice little way to pick up some cash. And more importantly, though, it's a fantastic way to hedge because if it's nighttime and you hear some news and you're able to trade, there's a TD Trade commercial or Interactive Brokers commercial where the woman's sitting at the restaurant and some crisis happens in Russia and she goes to her date. She's like, oh, hold on, I got to make a couple of hedging trades in the futures. And the guy's like, what? So he's like, he's sitting there losing his ass in his portfolio because the market's crashing, and she's sitting there making a huge profit because she can trade. Why would you not want that skill? Futures trading is worth practicing. And this is Thinkorswim. You can open up this thing. You can get a paper trading account in Thinkorswim, and you can practice to your heart's content. And it takes a lot of practice to just get used to the little movements like I do, and you see the way I hit this elevator button and so on and so forth. There's a lot of little things that you get used to, but it's not hard. It isn't on the whole hard. It's just a matter of practice and getting used to what looks like a fake signal and what looks like a real signal. And we can talk more about that in future things. All right, so that's our show for the day. People always at the last minute ask questions. It's not fair. Thank you, Robbie, though, otherwise I wouldn't have looked. On ABX, all I want to say is in 212, we like them at 30. I did like them at 30. I still like them at 30. I'll still like them when they are 30. In 2012, gold was freaking $1,800 or something like that. Of course we liked them at 30. And when they went down, we bought more. That's how you play it. I like them more at 15 than I like them at 30. I like them even more at 7 than I like them at 15. When they get back to 30, though, I'll probably be selling. I'm still on Hover 150. It's better to sell the January 2017 or the January 2017 2 put. Was it better to sell the call or the put? What kind of question is that? They're pretty different things. Maybe again, it's a survivor. You want to go through the cycle. Oh man, what did I just do? Canadian HOV. Well, I'm all for selling that put, but the question is, I would sell the put and the calls. If I don't know what your basis is. Did you tell me? You long Hover 150. Okay, fine. So you're at 150. So why don't you do this? You can just take the stock. You long at 150. So you sell. I sell the $1 calls. If you can get 88 cents for the $1 calls, why not? That's 188. You paid 150. That's 30 cents more. That's a 20% profit. Okay. So if you sell these for 80, I would want 90. You sell those for 90 cents. You sell these for 90 cents. That's $1.80. How much did you pay? $1.50? So you have a 30-cent credit. You already own the stock and you have a 30-cent credit because you sold the $1 calls and the $2 puts. If Hub is over $2, you're going to get $1 and you keep your 30 cents. So you have a $1.30 profit off your 30-cent credit. If Hub is below, okay, you'll get assigned, you only have a 30-cent credit and you have the stock. If you get assigned another round at $2, you still have your 30-cent credit, you'll pay $1.70 for 2 times the amount of stock you currently have. So that's going to be 85 cents. So what that does is it reduces your cost from 150 to 85 cents in your worst case, and your best case is anything over $2, you make a $1.30 profit. That's almost 100% of where you are now. Again, that's so good. That's so good. We have to put that in one of our portfolios. I mean, that would be crazy not to have in a portfolio. The only way you really lose money is if they go bankrupt. In the old team, most of the money is cash. Yeah, that's how it should be in a small portfolio. You want to be flexible. Should I go long SDS September hedge right now? I would. I mean, I certainly am worried about where the market's going to be. What about CVX? I have the 90 puts. Oh, we rolled those. Holy cow. Those are dead. We rolled those up to the 95 and waiting to see what happens with oil. But those are obviously going to be in bad shape. So, you know, we already made our adjustments on those, CVX. I mean, the 90 puts a toast, aren't they, by now? Yeah, they're down to like 27, 30 cents. So let's say you get 30 cents to those. You can go out to, you can buy the May 95 and you can sell the May 90s, and that would be about $2 on that spread. See, $1.99 and $4. So that plus the 30 cents that you have would put you in the 95.90 bear spread for a net of $2 plus whatever you lost on the other thing, which is, I'm sorry, whatever you said. So at least you have a chance to get your money back on the same trade. But the problem is going out further, it's a little bit worrying that this might not come back. So on the whole, you know, about 20 of them, that's a lot. The problem is oil is probably going to creep up at some point in May. So the further out you go, the more of a danger it is. But of course, if this conference ends in April, if this conference ends and they don't come to an agreement to cut production or halt production at this level, then oil is going to go down like a rock. All right, so it's a tricky trade right now. That's a really heavy amount that you went through, and it's already a loss. But again, CVX went up, oil's up right now. It's not a good day to probably make that decision. But we just pressed our bet. That's what we did. But we're going to be. I'm probably going to end up pulling the plug, frankly. So my answer is, what we did is we're going to we moved the position. Is this the do we have it in this one? We have the April 95 puts in the options opportunity portfolio. They're 255. They're down to 163. We lost $1,000. We already lost money on the other one. On the whole, we're probably going to just give up on it. Okay, it didn't work. End of story. I haven't been assigned at Hub 2017-150s. Why would you be assigned? I don't understand. You don't get assigned just because something's a little bit in the money. And that's all I have. I'm sorry, I'm missing that. You have the long... Oh, you have the 150 call. I thought you own the stock at 150. I would own the stock. You own the one. Why would you own the 150 call? Why? Please. Oh God, no. Don't be the person who pays premium to own a call. Those are the suckers that we sell to. Don't be the sucker. Okay? Your job is to sell premium, never to buy it. If you want to be, there is no 150. What? Now I'm very confused. Oh, this January. Okay, maybe there must be one in January. Let me see. Okay. So the 150 call is 40 cents or 35 cents anyway. Why did you pay? You paid if you paid 40, you paid 190 for 145 stock. Why would you do that? My way, I'm paying negative 30. I'm paying 85 cents for the $1.45 stock. You buy the stock. You can do the bull call spread instead, but I would just buy the stock. You buy it because you're paying a premium here, so why would I pay this premium? If you buy the stock, you don't pay a premium, right? So you're not paying a premium. You control the asset. You sell the calls for 40 cents. You sell the puts for. You sell these calls for 90 cents. So 145 minus 90, okay, plus, I'm sorry, minus another 90, so minus 180, 145 minus 180, 35-cent credit, or 30-cent credit, whatever it works out to. So you have a credit, you own the stock, you get called away $1, that puts another $1 in your pocket, and if it's under 2 and you get assigned, then you own the stock for 85 cents. That's way, way better than what you're doing. You need 180 just to break even. At 180, we're out of that thing with a nice profit. Even if we do get assigned to 2, if it's 180, it's no big deal. We only lost 20 on that side. That's how you play those things. All right, so I'm sorry that you played it that way. It's just you can't be a PSW member, can you? We would never allow that. We would never tell anyone to do anything like that. The Chevron trade actually made money for me. I closed it all out Wednesday when it hit 93. Oh, good. Okay, yeah. Well, that's good. I wasn't paying attention, frankly. It would have been nice if we did close ours out, but we didn't. And hopefully, we will get a little bit of a pullback, and we'll see what happens. All right, but what can you do? It went up today. The next chance is going to be Monday, but if it doesn't play out by Monday, expiration is when? It's early this week, isn't it? Yeah, it's the 15th. So expiration date is the 15th. So if by Monday that Chevron trade isn't fixed, we got to get out. We got to establish what we can out of it. All right, so it didn't work. We took a chance. We rolled up. We took another chance, and it's still not working. So time to give up. All right, I have got to stop this thing. That's almost 2 hours. I don't think we can do 2 hours. All right, thanks, guys, for coming, all right? And have a good week. We'll do it again next week. Thanks.